Good afternoon, everyone, and thank you for joining us on today's webinar, MLPs Back in Growth Mode. My name is Will Hershey of Yorkville Capital Management, and joining me today from Yorkville will be Darren Sharinga, founder and CEO. If you have any questions during the course of today's prepared presentation, please feel free to type them into the text box in the bottom right corner of your screen. We'll hold a Q&A session at the end of the call, and we'll do our best to answer everyone's question. With that, I'll turn the call over to Darren for his prepared remarks.
Thank you, Will, and thank you all for joining us on our quarterly call. The idea of MLPs and a lot of questions we've had from investors over the past year or the course of 2017 is the business model broken in any fashion, MLPs, and is growth going to return to the asset class? So, hence the title, Back in Growth Mode. We're just addressing the current growth in the macroeconomic factors that are backing the growth in MLPs, as well as the current growth. Right? You need to look at MLPs and look at distribution growth and the facts to see whether the asset class has moved back into growth mode. So the first slide that we have here is looking at MLP distributions in the third quarter of 17. If you recall, on our website we introduced, which is yorkvillecapital.com, we introduced our dividend tracker and our earnings tracker earlier this year, and it tracks all of MLPs as they report their earnings or declare their distributions, and then when they pay their distributions. So recently, 78% of all MLPs have declared their distributions for the third quarter of 17. And what we've seen is that 87% of all partnerships have either maintained or increased their distribution, and on average here, as you can see at the bottom of this pie chart, the growth rate has been 7.8%. So clearly 7.8% is extremely healthy growth rate. We'll contrast that at the end of the presentation relative to how Yorkville's growth opportunity strategy is doing, and our growth rate is significantly higher than this. So there are, again, MLPs that are growing distributions, the fastest growing in the mid-teens to mid-20 range. So again, from a business model standpoint and judging by, again, the facts, distribution growth rate is back in favor. MLPs are clearly in growth mode. So what's driving the growth? The next segment is on macroeconomic fundamentals that are strengthening really across the energy sector, and specifically as it relates to MLPs. So earlier in the year, I was speaking at a conference and I was asked what is the most important factor to monitor in looking at energy this year, and I said the most important factor I'd look at would be inventory draws, because if inventory draws aren't coming down, the number one problem which caused the great energy recession of 2015, which was too much supply, is not being worked through, which would mean the OPEC cuts and the non-OPEC cuts of 1.2 million barrels plus another 600,000 barrels, so 1.8 million barrels per day are not working. There's still too much supply online. So it was really a tale of two worlds, the beginning of the year in the first quarter, and then from the second quarter forward. So this chart here looks at change in total product inventories, and so basically that means oil, gas, and distillates. All three have come down on average 11 million barrels from the second quarter through last week. This year what we've seen is a drop 10 times that amount. So inventory levels have declined by 124 million barrels since the second quarter. So clearly the conclusion here is that OPEC cuts are working. So the number one problem we had of oversupply, the cuts have significantly or have addressed that problem to bring inventory levels back down. The second slide here is really breaking down the data. It looks very confusing. Let me break it down and simplify it a little bit. Focus on the black bars. The black bars are 2017 numbers. If they're pointing up, that means there's been a growth in inventories, total inventories, and if they're pointing down, there's been a decline of total inventories. And the dotted lines are the high level, so the maximum builds since 2010, and the bottom dotted lines are the draws, the maximum draws. So if you look from the end of the first quarter through present, you can see that these black lines are really almost consistently every single week pointing downward, and almost in most cases, well, in many cases, they are below the maximum level of draws ever experienced in that period of time over the last, since 2010. So again, draws of 124 million barrels, 10 times greater than historical averages, and consistently what we're seeing are draws on a week-over-week basis, many times above the maximum. So breaking news this morning, EIA came out with their numbers, which is the Department of Energy, and the draws again today were 6.7 million, almost 6.8 million barrels. The maximum draw in total inventories on a historical basis for this week, again since 2010, 5.8 million. So it's above the maximum draws ever experienced. Very important is bringing the global oil market back in balance, giving a floor under the price of oil again, and recently we've seen that the market focus is on inventory levels, OPEC cuts working. We've seen Brent in the mid-50s now, moving up to close to year highs, and 60s in Brent and WTI in the mid-50s, sorry. So very supportive of what we're looking at. OPEC current talk is that they are going to extend the cuts. And we'll find out at the end of this month when OPEC meets what the final plan will look like. Talk is right now that the cuts will be extended through the balance of the year, and then there'll be a tapering to bring back on OPEC's cut supply. And based on our estimates and IEA's estimates of where the global supply and demand balance lies, the markets would be able to absorb OPEC coming back online and still be in a balanced market condition at the end of 2018. So things look good from a macroeconomic perspective, actually very good. So the other question, again, remember on the next slide, MLPs are energy toll roads, and we've used that expression a lot over time because they are moving molecules from point A to point B, from the wellhead ultimately to the end user. And so the more volume you have moving through the infrastructure, and let's simplify and say pipelines, the better it is for the toll road owners. You're getting paid more tolls, you're moving more volume, more cars are flowing through your pipelines. So the U.S. production continues to march towards new all-time highs. If you look at this chart here, going back to 2011, we're at a little shy of 6 million. We peaked at 9.6 million barrels of production. We're now touching the 9.5, a little bit of hurricane disruptions here in the fall. But the trend line is we're almost at record levels of production again, and these levels of production are almost the most that the U.S. has ever produced. And in fact, in the 1970s, we hit our all-time high in production, which was a little over 10 million barrels per day. So the energy revolution that we've been speaking about, driven by unconventional shale plays, is still alive and well in the United States. And when we look at forecasts of growth next year, we'll probably average over 10 million barrels next year in 2018, meaning that by the end of the year we'll probably be producing record levels that this country has ever seen in production. Wonderful for MLPs. Again, the toll road, we want to see production levels increasing. There's more to the story, and in a lot of questions, so where are new areas of demand coming from? Very important for us, again, especially from a U.S. perspective. We are becoming the world's largest energy producer. Again, how could there not be opportunity to make money in an area where the U.S. is going to displace Saudi Arabia is the largest natural gas producer, and Saudi Arabia is the largest oil producer, and Russia is the largest natural gas producer, and we'll produce both of them. We're not one country doing each. We're going to be producing more than either country of both. So there's a tremendous opportunity here coming forward. Last year, the 40-year ban on exporting oil was lifted from the United States. You can see this chart. We were exporting roughly 500,000 barrels a day. It's peaking recently at 2 million barrels a day. And that makes sense because countries are looking to diversify their sources of oil. They're also looking for more oil. Again, the oil market's becoming imbalanced. Meaning to meet global demand, you need to find new sources of oil. The U.S. is becoming, since we're now an exporter of oil, a source to meet global demand. Number one, from a diversification standpoint. Number two, because of declining inventories, there is need for more oil on a global basis. So 2 million barrels a day, and as you can see, again, a little choppy based on this chart, but trending upward in the right direction. So that's new demand for U.S. oil production. The real story here, because when you look at the IEA numbers, which really does a great job at forecasting demand on a global basis, peak oil demand, which oil primarily is used to produce gasoline, so peak gasoline demand in the United States and in Europe, it's around peak levels right now, and the forecasts are, and our forecasts as well, are for declining consumption of gasoline. So what does that mean for oil? Well, the rest of the world, the developing markets, are not at peak oil demand. So oil has many more years before we reach peak demand. You look at some numbers, it's the mid-40s or beyond before we reach peak oil demand. The real play that becomes interesting, so if we displace gasoline-burning cars or diesel-burning vehicles with electric vehicles, we still need to produce electricity. And the next slide deals with the opportunity there, which is really what are the sources for production of base load demand electricity. We know coal's dirty. No one wants to use coal, not even China, which is a developing market, and it's relatively inexpensive fuel, fossil fuel. The clean burning alternative is natural gas. The revolution in the United States is as much oil as we've discovered through our unconventional shale plays. We have 50 years of supply on hand based on current production levels. We have 100 years of natural gas on hand, and we are the lowest cost producer in the world of natural gas, producing in the $2 range. So we have a tremendous competitive advantage in natural gas. Prior to the beginning of this year, natural gas was really weather dependent in the United States because it was a landlocked commodity. The only way you could transport it was through pipelines. Now through LNG, liquefied natural gas, you actually have the ability to transport natural gas around the globe like you do with oil. So Cheniere was the first partnership and company in the United States to start exporting LNG. You see their first cargoes were going off at the beginning of last year, and you have seen a tremendous amount of growth, 6x from last year through current in terms of LNG exports. Globally, you'll see more and more LNG import facilities being built, floating LNG import facilities, which means you don't even need to build the assets on land. You build them. You build a boat and you put the boat out in a harbor, and you regasify the LNG at sea and then bring it on land. So a tremendous opportunity for producing baseload electric demand, because as developing markets continue to develop, not only again they drive more cars, consume more gas, and they're going to consume more electricity. Whereas what's the best fuel right now on a global basis for that? It's natural gas, the cleanest burning. So and the U.S. has a tremendous advantage. So two new sources of demand. We're exporting oil. Now we're starting to export natural gas, and these are wonderful opportunities, again, for more volumes, as being the toll roads that charge a fee for moving molecules from the wellhead again to the end users. Looking at MLPs, it's been a tough year for them, and we came out of the great energy recession of 2015, bad year, 2016 a good year, and then all of a sudden in 2017 the wheels have fallen off the energy complex pretty much from a price perspective, not a fundamental perspective. I just pointed out to the growth that MLPs are delivering. Clearly that growth is not being valued in the stocks right now, leading to compelling valuations. MLPs last week, midweek, hit year-to-date lows. And And so if you look at what does that mean when you are, as investors, faced with where do I put my assets, you have alternatives. And you look at MLPs relative to utilities and REITs. MLPs are yielding 8% currently, and growing. The ones on average that are growing distributions are growing it at roughly 8% per annum. So you have 8% yield. Utilities are yielding 3.3% and REITs 4.1%. So the same $1 million in MLPs is going to produce $80,000 a year. It's going to produce $33,000 a year in utilities. You're going to produce $41,000 a year in REITs. So you're doubling your income from any other of these asset classes relative to MLPs currently. So income is a big component of valuing MLPs and valuing other equity income peers, and clearly it's the only component you use in that and default risk in valuing fixed income. So historical yield spread analysis. This again is a complex chart, but it's worth looking at because it's an indication of the value. We showed on an absolute basis where the three asset classes were trading 8% for MLPs, 3.3% for utilities, 4.1% for REITs. You look at the spread now, so relative, MLPs relative to, in the first case, utilities. Historically, MLPs have traded at a 3% premium to utilities. So that would mean 3% added on to 3.3% yield would be roughly a 6% yield is a fair valuation for MLPs based on historical trading ranges. Currently, MLPs are trading at 8%. And similarly, if you look at the next bar, which is the comparison relative to REITs, MLPs have traded at 2.8%, while REITs are trading at 4%, so it would be roughly 6.8% would be a fair valuation for MLPs currently. Clearly, MLPs trading at 8% it means that their yields could compress and still give investors the premium of income that they're used to receiving from investing in MLPs, which means the only way yields are going to come down if they don't cut distributions, and they're growing distributions, MLPs, across the asset class, as price goes up. And as price goes up, your yield comes down. So on an absolute basis, MLPs look very attractive. On a relative basis, which is what this next chart is demonstrating, MLPs again look attractive from an investment standpoint and have lots of more upside potential relative to where they traded against REITs and utilities. The next slide looks at another look at this, because one of the problems facing or concerns facing investors today is U.S. equity markets are trading at all-time highs. And pretty much across the board, valuations are stretched. And so what are investors to do? Now, when you look at that, the concept of stretched valuations, this is really what this chart is addressing here. And if you look at utilities, this is where utilities are trading currently relative to their historical low yield over the last 5 years. So the most expensive they've traded relative, right? Expensive means low yield. Utilities are as expensive as they've ever been over the past 5 years. Generally, from an investor standpoint, not a great time to be investing in an asset when it's trading at all-time highs, unless there's a tremendous growth trajectory in front of it to say, okay, this is going to justify me paying these prices because it's going to grow into it. Utilities generally are not growth vehicles. So the fact that utilities are at all-time highs, that would be a similar experience as what the S&P is currently trading at all-time highs. REITs are almost trading at all-time highs. They're less than 1% off of their or recent all-time highs from a valuation perspective. The only one that has a significant spread to where it's traded at over the last 5 years relative to its yield is MLPs, again, almost 3% above their peak valuation levels. So again, utilities are relatively expensive based on where they've traded historically. REITs are relatively expensive, and MLPs are relatively inexpensive based on historical trading ranges. So you're looking at that and then just putting it into an investor's perspective here, and we've touched on this in one of our recent MLP beats over the past quarter. What you're looking for as an investor, if you're investing at all-time highs in an index, and especially at a valuation level or an asset class, you get a bad risk-return profile. And what do we mean by that? We mean that you have greater downside than you do upside. So if you look at the maximum loss in the S&P 500 going back to 2000, so it's been through two downturns, 2000 through 2002, and then again in 08, the S&P's lost over 50% of its value through the downturns. So that becomes a downside potential in an asset class. And what's your upside potential? Well, when you're trading at all-time highs on valuation basis, your upside potential is not that much higher. It's hard to justify moving a lot higher. So you have greater downside risk than you do upside potential, and you find that in a lot of the U.S. equity markets right now. And arguably, utilities and REITs would fall into that as well based on the analysis we've just done. MLPs not. You still have much more upside based on historical trading ranges, 60% to the upside, 33% to the downside, and that's getting to historic lows. That would be like getting back to another 08 in the index. So less downside potential relative to upside. That's an attractive risk-return profile. That's what you're looking for as investors when you want to get into an asset class. You certainly don't want to be buying something when it's trading at all-time highs. Again, it skews there's too much risk relative to the return potential. There is another factor when we look at the equity markets right now and the MLP markets specifically. Through mid-last week, touched year-to-date lows, so clearly a very bad year so far. The MLP debt markets are posting positive returns, and there's something that is been said on Wall Street for many years that probably the better analysts are the debt analysts, because there's no upside potential for debt holders. They are concerned with one thing, two things. Is the company going to make its interest payments on time, number one, and number two, are they going to pay the principal back when the loan matures? And that's it. And if they're going to meet those two criteria with a high degree of certainty, well, I'm willing to lend the money in at a certain rate to do that. Whereas equity investors are worried about what's my potential. Can I make 1-2 times my money, or what's my return potential? So they have much more upside. So debt investors are much more fundamental-based investors. And if you look at this next graph here that we've prepared, this line, the black line on the top, MLP bonds, is an index that Yorkville's created. It contains all MLP bond issuance or bonds from all the MLPs that are in the market right now. It's something that we do exclusively and track it. You can see from the beginning of 2017, MLP bonds have actually traded up 6.2% on the year. They produced a positive return. At the same time, through last week, the Alerian index, which is the index we're using here, was down by 11.6% on a total return basis. So they're moving in opposite directions. Bonds are going up and equities are going down. Now, they're the same companies, correct? It's not as if these are different companies. The MLPs that issue bonds also have publicly traded equities. So those are the only ones that we're tracking. The question is, who's right? Are the bondholders wrong and they're mispricing risk? Because clearly the bonds have been trading up and equities have been trading down. So generally speaking, bonds are good indicators of of the fundamentals of the asset class and the fundamentals and the strength of the balance sheet of the partnerships and the cash flows. So what the bondholders are saying is the fundamentals across the asset class are improving. Hence yields, hence prices are moving up and yields are moving down. The equity holders, on the other hand, are selling the stocks and are hitting year-to-date lows again through last week. So we clearly, given the growth that we've seen, believe the bondholders are right, and there's a disconnect between equities and fixed income. We believe that fixed income is a leading indicator, and it will determine the direction of equities going forward, which means equities will be moving up. The cost of capital divergence, it's a slide that's really looking at the inverse of what we just looked at, and that's price goes up, yields go down, price goes down, yields go up. You've seen a divergence. Again, the black line is the price of debt, or the cost of debt has gone down from across the asset class, and the price of equity, because the valuations have gone down, the stock prices have gone down, has increased. So again, it makes it more attractive from an equity perspective. You're certainly being paid more to own the equities, and the one thing that's nice about owning the equities when you're getting paid to wait is equities are growing. So current yield plus growth in distributions equals your total return potential of the asset class again, or of your investment. That's been a back of the envelope calculation we've said to look at, and it's one that we actually use internally. So MLP equities are becoming more attractive, and you're paid to wait, getting more income to do so, and you're getting growth of income in bonds. You're getting no growth of income, but bond yields are coming down. So again, it's on a relative basis, equities are becoming a more attractive investment at this point than bonds are. Moody's, the credit rating agency, has made a lot of right calls in energy, and this next chart shows the total return again of the Alerian index, and going back to the peak of the market in 2014, this is the peak of the MLP equity markets. Moody's downgraded in the summer of 2015 the outlook for midstream debt, and that was the right call, because from that point forward you can see that MLPs almost dropped considerably, and the bottom wasn't put in yet. And so Moody's continued to have a negative outlook on the midstream debt until recently, and you can see this this past fall, Moody's upgrades at the end of this chart the outlook to midstream debt, so from a negative outlook to a positive outlook on the space. So again, Moody's, whether they were early enough in the last cycle in calling a deteriorating outlook, and they were right given what happened in 15, and they've upgraded the fundamental outlook for the space is really what they've done here. So we think the debt markets are correct. In summary, that will lead to based on all of the strong macroeconomic fundamentals that we mentioned earlier, will lead to an uptick in equity prices going forward. So how is Yorkville doing, and how are we navigating these markets? And so we highlight a couple of strategies today. Our flagship strategy, which is our award-winning MLP growth opportunity strategy. It is a growth strategy, as the name says, and we are delivering on our promises of growth. As I mentioned at the beginning of this webinar, the companies that are growing distributions or maintaining distributions this quarter are growing roughly 8%, a little shy of that. The MLP growth opportunity strategy is growing distributions at 12% on a year-over-year basis for the third quarter. That compares to the overall Alerian index, and now this number is lower at 3.7% because that includes companies that have cut distributions again. and we certainly want to avoid companies that cut distributions. As we said, you generally see a big sell-off and loss of equity value after that. To reiterate, the strategy through both the downturn of '08 and then again 15 has not had a distribution cut. So our ability to deliver high-quality growing income through all market cycles has been in place, and it remains in place today. So again, back of the envelope calculations, growth plus income equals your total return potential, average distribution growth at 12%. That's really incredible cash-on-cash growth rates. So that's more than a hedge against inflation. That is also protection against rising interest rates, which, as the Fed is now into a tightening cycle again, or the beginnings of a tightening cycle, you want to protect yourself against rising rates by something that is growing its distribution or income. So again, almost spread over the Alerian index of 8.4% in premium growth in the global opportunity strategy. On an annualized basis, a 5 years basis, we are delivering positive returns of 5%. These are gross numbers. Alerian is down 0.6% on an annualized basis over the past 5 years. So almost 600 basis points of positive alpha over the index, which is indicative of what we are capable of. One of our strongest suits is as we start to come out into a growth market again, we tend to even do better, and we've been in really choppy markets. So how are we navigating them? Relatively well over the past 5 years. Clearly a lot better than a passive index, which is one of the reasons why you want active management, and that's also attested to in our 12% growth rate relative to 3% across the entire asset class. The second strategy we're highlighting today is our high income strategy. We unveiled it earlier in the year. It's producing outsized yields, and that's what it's meant to do. The same high quality growth that we offer in our growth opportunity strategy. We're looking for high quality income in our high income strategy. We're delivering. Yorkville MLP high income strategies yielding 12.6%, which is incredible. There are very few asset classes in the world that you can find that are yielding 12.6% with quality backing the distribution. So positive distribution coverage above 1, and in some cases some growth of distribution. So there's been a disconnect in the markets between debt and equities, and that's given us as fundamental stock pickers a wonderful opportunity to identify companies that are mispriced right now, and a big part of the mispricing is yields that are outsized relative to the business fundamentals. So the Alerian index, again, a little shy of 8%, so it's almost 5% extra income that you're able to pick up in the Yorkville MLP high income strategy. So you get extra income. How does that compare relative to the Alerian on a historical basis? Again, inception date here is October 1st, 2015. So in the midst of the bear market of 15, the high income strategy on a gross basis has produced 10.7% annualized returns relative to the Alerian, which has produced 4.2%. So again, significant 600 basis points or 6% of positive alpha over the benchmark since inception. A testament to Yorkville's skills as stock pickers and investors, and ultimately to active management versus passive management in this perspective. So that concludes my comments on MLPs being back in black and in growth mode, and we continue to anticipate, given improving fundamentals, that the best days for U.S. energy infrastructure remain ahead of us, and that will be driven by continued new growth of exports of oil and exports of LNG to around the globe. The U.S. will become the largest energy producer on a global basis, which is incredible to think of, and the one way of capitalizing on that is through, in a relatively safe perspective, is through U.S. energy infrastructure, where you're paid to wait and still participating in the growth of the overall energy complex in the U.S. So, Will, back to you.
Great. Thank you, Darren, for the presentation. I know Darren spoke a bit on recent earnings announcements and distribution announcements more specifically. Just want to remind everyone on the call that we are keeping track of those earnings and distributions as they roll in throughout earnings season on our website. We have a page dedicated just to dividends or distributions as they're known in the MLP asset class. We also have a page dedicated just to earnings at www.yorkvillecapital.com. So just a reminder there that you can keep track of the entire asset class on our website. With that, we'll begin the Q&A portion of the call. As a reminder, if you have any questions you would like addressed, please type them into the text box. You'll see it in the bottom right corner of your screen. And we've had several roll in, so we'll get right into it. I'm kind of combining a few here because they're somewhat similar and really play into what we talked about. But why the weakness in the MLP equity market? What's going on? And I'll chime in as well.
Please do. So I think the whole case we've been trying to make here is there's a disconnect between fundamentals and equity values and the price performance of MLPs. You have growth of distributions, you have growth of production in the United States, you have new sources of demand, exporting oil, exporting LNG, and all of this is good for volumes. We're almost producing oil at record levels never seen before in the United States. So what gives with the disconnect between valuations and price and fundamentals, I'm not sure. It's been perplexing for this year. I'd say one thing that makes the most sense to us as a firm is that the idea that OPEC, and the reason we ran into trouble in 2015, the great energy recession of 2015, was due to oversupply, and that oversupply was because the United States became so prolific in producing oil from our unconventional shale plays that the markets became oversupplied and the price of oil then went below $30 a barrel. So it created the demand on a global basis is been extremely robust and is forecast to grow another 1.5 million barrels this year, and next year a like amount. So, well, that's 3 million additional barrels over the next 2 years. And when you look at that, that will absorb all of the OPEC's production as well as increases in U.S. production. There's really nowhere else in the world that's growing production. So you have OPEC that's offline due to the cuts, and then you have growth coming out of the U.S. Outside of that, it's pretty flat growth, and there's been a lack of investment. So we think that part of the problem and other energy markets, as we pointed out earlier, have even been hit harder than MLPs. MLPs have been the relatively safe haven relative to the E&P index, the producer index, or the oilfield service index, that you have the OPEC overhang right now. The only fundamental concern is that OPEC doesn't cut, doesn't extend, and floods the market with oil again. And everything we're hearing is that they'll, that cost them, what was the number? Well, $3 trillion, I think.
Something like that.
They published that when oil went down last time. So they have a real economic incentive to keep oil prices up. And the fact that the markets will be organically balanced, which means that they can produce to their maximum levels with no cuts in place at the end of next year, I think they're highly incentivized to extend the cuts from March through the end of the year. So I think that would be the only fundamental I can see, because nothing else outside of that makes any sense. In October, the poor performance, a lot of people don't know this, but MLP funds, so your mutual funds, your ETFs, have fiscal year ends that are October 31st. A lot of tax loss selling would have gone into play to realize losses in your fiscal year so that your investors can benefit from losses in the overall fund. And so that would have added to selling pressure in October. So I think outside of that, at the end of November, we'll have a decision from OPEC, and we'll see what that is. That is really the one piece of uncertainty. And once that's behind us, clearly the current levels of cuts and the production increases coming out of the United States, given that inventories are being drawn down at the rates they are in the U.S. and globally, the cuts are working. The market is undersupplied right now, so that produces a good floor for energy and a good outlook for energy going forward.
Yeah, the tax loss is a really good point, because I think a lot of people probably don't know, one, how much ownership actually lies in MLPs in funds, and two, that the year-end, fiscal year-end just came through. And I think on top of that, it's a short-term effect as well, but we did see actually BP launched their IPO. Interesting timing given what we know was going on with the year-end and everything else, but did actually launch an IPO of their midstream assets in the form of an MLP. I think, one, probably some cash was raised to participate in that offering is one takeaway, and number two, is really that the MLP, it's really a kind of another stamp of approval, right? A really huge super major going out and doing a standard structured MLP, actually with IDRs in this case, really an endorsement for the asset class and the structure going forward.
Another factor as well, which is the institutions are not interested in MLPs because they're interested in the stock market and the tremendous growth potential that's been exhibited thus far. So they've been dumping the MLPs, and when you see MLPs trading 1, 2, 3 million shares, units, you know it's not individuals. It's the institutions shunning the MLPs because they can make a lot of money in the stock market.
Thank you, Len, portfolio manager with Yorkville, on with us as well. One other question I just wanted to clarify, because I saw some related question on it. What are our funds tickers and how can they be accessed? Just to clarify, the two strategies we highlighted today are primarily offered through separately managed accounts. We do have a mutual fund through a partner, James Alpha, which tracks the first strategy Darren mentioned. That's the growth opportunity strategy, but these are primarily separately managed accounts. Feel free to call us. You can see the number on the bottom of the screen. If you have any more questions on how to invest, 212-755-1970. You can also email us as well. Moving on to further questions, and normally we wouldn't necessarily answer this type of question, but I've seen it come through so many times that I think it's important. What are the concerns with regards to tax reform? Because I know taxes is at top of mind for a lot of people right now, so it is a fair question. And what do we think happens with MLPs? And I'll just start, and I'll let Darren or Len chime in. Really, and I don't think the study's been done on this in a handful of years, but when you looked at how much money could be raised in terms of incremental tax dollars by getting rid of the MLP's favorable tax status, not paying corporate taxes, really the number was de minimis when you look at it in terms of what's going on with the total budget. It was measured in billions of dollars, not tens of billions of dollars, below 10, in fact, if my memory serves. So I think that probably way lower down on the agenda given what's going on. So I think it's probably not something too concerning, but the fact that it's been mentioned in a handful of questions here certainly lends itself to the fact that some people may be probably wrongfully selling due to that concern.
Len, do you want to take a
Yes,
stab
I
at
will
that?
also add that given the number of states that have senators and congressmen and are dependent upon donations from oil and gas interests, the chances of the MLP taxation being changed are just about nil.
Exactly, agreed. Moving on from taxes, because who knows what's going to happen politically. We're not going to try and.
You know, I think there's one last way of looking at taxes. A lot of MLP. So, really, what is MLP? MLP is a structure. What are the assets? The assets are infrastructure assets. So the assets are hard assets. They're like a utilities assets. They're not going anywhere. These assets produce cash flow. So the MLP structure doesn't produce cash flow. The underlying pipelines produce cash flow. So we've seen a number of U.S. energy infrastructure assets go public to provide investors access to this cash flow from these hard assets through normal corporate structures, no different than GE or any of the FANG companies right now. So that they've chosen not to take the tax advantage structure of an MLP, but just take these same assets that are great cash producing, stable cash producing assets and put them in and go public in a C Corp structure. So I think that we've had this debate in the past. Even if the structure changed and all MLPs became C Corps, number one, it wouldn't raise a lot of money. And to answer Will's question, the last time the study was done by the Congressional Budgeting Office, it would raise $5 billion over 3 years in tax revenue, so $1.5 billion a year if you taxed the entire asset class of MLP, so a de minimis amount relative to almost $500 billion market capitalization in the asset class. And number two, if they did all become C Corps, we still own the same assets, we still have the same cash flows, except a larger investor base could now access MLPs that through K1s, many mutual funds don't touch them, many tax-exempt investors don't touch them. So I think it could actually bring more demand into the asset class. I don't think it's going to change the structure, but it's not catastrophic to MLPs because MLPs, they own assets. The MLP structure doesn't produce cash flow, the assets produce cash flow.
It's a great point. Same way
Another factor, by the way, is if the MLP structure were destroyed, very few people would be building pipelines, because the return on building is, the initial investment is so huge and the return is so relatively small that new pipelines and new infrastructure would be hard to justify from a business point of view.
And then you go right back to the inception of the asset class at that point. Why was this structure created? To incentivize investment in the U.S. energy sector, so that we can increase production, right? That's the inception of why MLP started up for that reason, so thank you.
Okay, great. And I think that actually, Darren, what you hit on in terms of midstream assets being in C Corps kind of houses, being housed in C Corps kind of lends itself to the next question here, so we'll move on to that. One of the participants mentioned EPD, MPLX, MMP moving more towards a model where more cash flow is retained versus paid out, which is what we see kind of more in the C Corp space. How should we look at that model going forward if it's going to be the status quo, and is it good for the industry?
Sure. So it's good for the industry. That's our answer. It's good for the industry for two reasons. One is because it reduces the risk. Remember, MLPs, if you are paying out a 90% of your cash flow in the form of a distribution, how do you fund, to Len's point, the next pipeline? We have to go back to the capital markets, and you have to tap the debt markets and the equity markets in order to raise new capital to build your next pipeline. And the problem with that model is when the equity markets close and the debt markets close, as they do in catastrophic environments, so 08, 15, early 2000s, that it really puts a lot of strain on the MLP structure. And so by retaining more of their cash flows and self-funding a larger percentage of the equity, it de-risks the business model. It also gives a higher coverage ratio, right? You're not paying out 100% or 90% of your cash flow. You're paying out 67%, so you're retaining 2/3 of it. Well, you have a lot more flexibility now in maintaining your distribution in a downturn because you're not as close to the wire. You have some cushion in there. If whatever happens to your business model, if growth slows down, you're not going to have to cut distributions as rapidly. So for both of those reasons, and two reasons, one and two. Now the third reason is that you're also now, when you retain more of your cash flow to fund equity, it's less dilutive. So longer term, that there's a short-term blip as you recalibrate, right? Short-term slowdown in growth because you're not paying out the same amount, right? You have to build that reserve up and grow your cash flow before you start to grow your distributions as aggressively again. But after that point, you've de-risked your business model. You're going to issue less equity to produce the same amount of growth. All of a sudden, you'll be able to actually accelerate your cash flow growth on a per-share basis. So it's a short-term, tap the brakes, grow cash flow without increasing distributions as much, increase coverage ratio, de-risk the business model, and then 2, not have to go to tap the capital markets as often, which means less dilution. So after this is reset, the whole asset class has been de-risked and can now grow at a more rapid rate with less risk, which is to us all much better.
No, it's really a maturation of the asset class, also catering more towards what's become an increasingly institutional investor base, right? Over time, we've seen a lower percentage of the ownership, as reported by the K1s, primarily done by PwC. Lower percentage over time has been retail.
And there's one other trend that we're seeing take place in MLPs as it relates to structure, and that is the GPLP, general partner and limited partner, and something called incentive distribution rights. That ultimately, I'm not going to go into them right now, becomes an expensive source of equity capital, which is a way of looking at it, that the GPs and LPs are being rolled into one and ultimately getting rid of this IDR, an expensive source of capital. So as more and more institutional investors are coming into the asset class, questioning certain aspects of it, looking for de-risking it in other areas like more coverage ratio, less dilution of equity, that this is the evolution in sort of MLPs version 2.0 that will take us through the balance of the U.S. energy revolution, which is a much safer business model long term.
Yeah, improved corporate governance in addition to being a bit smarter maybe about return of capital decisions. Darren, you alluded to this earlier, but the OPEC meeting, we know it's at the end of the month. What do we think is going to be the outcome? I know you touched on it briefly, and what are the effects of that outcome?
So who knows what the outcome would be, and I know Len would say something similar to that if you asked him the price of oil, and who knows, honestly. It's really hard to predict. The outcome of the meeting, though, what an expression used on Wall Street, what's the chatter, what's being released to the press, what are we able to gather, is that it looks like there will be an extension. And I would even say more strongly than that, I'd say the Street's expectations now are that there will be an extension. And I would even go further to say that I think that the Street anticipates the extension will be through the end of the year. Is sort of what's the current thinking right now. So current thinking would be that you'd have a 9-month extension to take it from the end of March through the end of 12/31. If that materializes, then what you'd actually anticipate all of next year are inventory draws that we've been experiencing this year. So throughout all of 18, this would be the type of inventory numbers that we'd see, which would be incredible. And then there'll be, and so, I'm not sure, based on, our forecast and IEA forecast, that OPEC could start to bring on supply before the end of the year. So whether the cut goes through the end of the year, they start to bring supply back on, and a tapering again is what it's being called, to not flood the markets by just opening the gates and bringing 1.8 million barrels back on all at once, but slowly bringing it back into the market. I think it'll be a combination thereof. So and both would be good for at least supportive of the prices of the price of oil where it is right now. But I certainly don't expect oil to shoot up, and nor do we as a firm anything above this, because you have all the supply. So OPEC would meet it with coming back on with some supply.
And I think one other reason outside of the Saudi Aramco IPO, which who knows what or when that will come to fruition. And I think, Darren, you've made this point in the past. We're talking about less than 2 million barrels for OPEC, which is producing a bit over 30, right around 32. They're taking a small haircut in terms of what their production is for a material increase in the price. The price increase that they're getting for if they were to fully produce, it's certainly worth that trade. You do that trade all day.
Well, I mean, if you look at $26, the low of oil, over 50 right now, you've doubled your revenue from 26 to 50, and you've cut 1.2 million out of 32 million barrels a day. So less than a 5% cut for a doubling of your revenue. It's a pretty good trade. It's a great trade. Yeah,
it's a great trade. Yeah. One actually observation, I'm just going to read it because I think it's a great point from one of the participants. As return on equity improves for the MLPs, it makes a powerful case for the relative yield argument versus utilities and REITs, and I think that's definitely on point. Would you guys agree?
Absolutely. Yeah.
Yes.
Okay. I think we're pretty much rolling up on the end of the hour here, so I want to thank everyone for the time with us on our call. As a reminder, a replay, if you happen to join us a bit later, will be available in the coming days. Hopefully tomorrow, if not the day after. Look for it there on our website, www.yorkvillecapital.com. So once again, thank you all, and we look forward to speaking with you again soon. You can reach out to us if you have questions on our strategies, either via phone or email as well. Thanks so much, and talk again soon.
Thank you.